Assalamualaikum warahmatullahi wabarakatuh. So I will explain about journal entries. Journal entries are the bread and butter of accounting, which is capturing every business transaction in a neat and organized way. They lay the groundwork for financial statements and are the key to keeping your books in order. Why journal entries matter? Journal entries are a big deal for a few reasons, which is number one, spot on financial reporting, which is every transaction needs a journal entry which then gets posted to the general ledger. This is crucial for creating financial reports and filing taxes right. So next, number two is keeping tabs on business health. Recording transactions helps businesses track their financial health and performance over time. This info is essential for making financial statements like the income statements, balance sheet, and cash flow statement. Number three, playing by the rules, which is journal entries make sure a business stick to accounting standards and principles, providing a clear audit trail for each transaction. Lastly, accrual accounting. Adjusting journal entries are needed to match expenses and revenues accurately within each accounting period, ensuring a precise balance and income statement. So next, what makes up a journal entry? Which is number one, transaction date. The transaction happened. Number two, affected account. The specific account hit by the transaction, including account numbers. And lastly, amounts. The amounts debited and credited to the respective accounts. Description. A short note giving context for the transaction. So, the summarization about the journal entries can be broken down into different types like journal entries, compound journal entries, adjusting journal entries, and reversing journal entries, each with its own in the accounting cycle. Getting a grip on these components is crucial for accurate bookkeeping and keeping a clear financial record. That's all from me for journal entries. Thank you.
Hi, my name is Nushafiqah Binti Abdul Rahman and I'm here to present about ledger entries. So ledger entries are the record of all financial transactions in a business organized in a systematic way. A ledger is like a big notebook where a company keeps track of all its financial activities. Each type of activities like sale, expenses, or purchase has its own account in the ledger. Meanwhile, a ledger entry is a written record of a transaction that shows what happened with money. Each entry typically has date for when the transaction happened, account, the specific category, cash, sales, or expenses affected by the transaction, amount is for how much money was involved, and lastly, debit or credit. Every transaction has two sides, which is debit and credit. Debits and credit ensure the financial record stays balanced. How it works is, for example, if a company makes a sale, the sale amount is recorded as a credit to the sales account because sales are a type of income. Then, the same amount is recorded as a debit to the cash account because the company now has more cash. The key idea is that every transaction affects at least two accounts to keep everything in balance. In summary, the ledger entries are used to track and record every financial movement, ensuring the business accounts are accurate and balanced. Thank you.
Hi, my name is Nur Alana Bila binti Muhammad Nasir. I'm gonna explain about a trial balance. What is trial balance? A trial balance is an accounting report that lists the balance of all general ledger accounts at a specific point in time to ensure that total debits equal total credits. It helps verify the accuracy of bookkeeping and is used as a basis for preparing financial statement. The trial balance includes account name, debit balance for asset and expenses, and the credit balance is for liability, revenue, and equity. If the total are equal, the books are considered balanced, but discrepancies indicate error that need correction. However, it does not detect all types of error, such as missing transaction or incorrect account usage.
Okay, next I will explain about SOFP. In accounting, SOFP stands for Statement of Financial Position or Balance Sheet, the fundamental financial statement that show a company financial condition at a specific point in time. Here's a breakdown of its key component. First one is asset. These are resources owned by a company that have economic value. They are divided into first one, current asset or short term, expected to be converted to cash or used up within a year. Example, cash, account receivable, inventory, prepaid expenses. Next one, non-current asset or long-term, held for longer than a year. Examples, property, equipment, and tangible asset like patents and investment. Second is liabilities. Liabilities represent obligations the company owes to outsiders. They are also divided into the first one, current liabilities, obligation due within a year. Examples like account payable, short-term loans, and accrued expenses. Next one, non-current assets, liabilities, obligation due after more than a year. Examples like long-term loans and bonds payable. Third one is equity. Equity represents the residual interest in the company after liabilities are subtracted from assets. It's essentially the owner's claim on the business. Common components include share capital, money raised from issuing shares, and then the second one, retained earnings, profit reinvested in the business, and then reserve, funds set aside for specific purpose. Next, the main point is SOFP equation. The SOFP must always balance according to the equation. Asset equal to liabilities plus equity. For example, a company owns assets worth 500,000 ringgit and then it owes liabilities of 200,000 ringgit. Therefore, the equity is 300,000 ringgit. Why the SOFP is important? The first one is assess financial health. It provides insight into a company, liquidity, solvency, and financial stability. Second, understand business value. It shows how much of the business is owned by shareholders versus creditors. And then at decision making, used by investor, creditors, and management to make financial decision. Okay, that's all from me.
Hi, my name is Nushafika binti Abdul Rahman and I'm going to present about the statement of profit and loss. So SOPL shows how much money a company made or lost during a certain period, like a month or a year. So the key parts are revenue, cost of goods sold, gross profit, operating expenses, and also net profit. So first one is revenue. For revenue is how much money the company earned from selling its product or services. Next is cost of goods sold. It is the cost to make the product or provide the services. Next is gross profit, the money left after subtracting the cost of making the products from the money earned. Moving on to the operating expenses, it is the cost to run the business like rent or utilities. And then operating profit. So operating profits are the money left after all business costs are subtracted from gross profit, and the last one is net profit. It is the final amount left after all expenses, including taxes, are subtracted. That's all. Thank you.